All right, guys. Today we're going to give you a bit of a summary on the year that was and what a year it has been. Also, too, we're going to bring out the Magic 8 Ball and have a look into the future. My name's Brett Evans and I'm the Managing Director for the Europe, Middle East and Africa region for the Atlas Wealth Group here in Dubai. And today I'm joined with my colleague Adam Prentice, who is a planner as well here, based in the Dubai office. G'day, Adam.
G'day and hello to everyone. Thank you for joining us today.
Fantastic, guys. Now let's get the show on the road. We love to keep the lawyers in the world happy, and as well as the compliance officers. And what this disclaimer essentially means that all the information we're going to share with you good folks today is for informational and educational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, please speak to a licensed professional, someone like Atlas maybe. We've got two disclaimers. We've got multiple jurisdictions and multiple offices here. So this just refers to our local domicile here in Dubai. We're regulated by the DFSA, and these are our details. We're also regulated in Australia too. So we have two powers that be that we subserve. So who is the Atlas Wealth Group? We're the leading provider of Australian expat tax, financial advice, mortgage and asset management services. We're regulated by ASIC, the ATO and the DFSA here in Dubai. Lots of acronyms there. We have clients in over 50 countries and we currently manage over $500 million in assets for our clients. All of our specialists, whether that's a mortgage broker, whether that's a financial planner, whether that's an accountant, are degree qualified in that category. They don't have an arts degree and did a back of a cornflakes packet to get a financial planning certification. We're all degree qualified and we have numerous postgraduate certifications. So today, what are we going to talk about? And Adam and I are going to run through a bit of a macro backdrop and what's going on in the world. Adam will run through the Australian and the international equity side. Then we'll have interest rates and Australian residential property by myself. Adam will discuss the Australian dollar and other foreign exchange considerations, and then portfolio implications, and then we'll run through the Q&A at the end. All right, guys, from a macro backdrop point of view on the international side, I think it's safe to say over the last couple of years, the market's been, and the economy that is as well, but especially the market, has been firing along at a great rate of knots. And all we're seeing right now is, I guess, what can be described as a bit of an orderly slowdown. And that orderly slowdown pretty much started last year when we had interest rates starting to rise. Obviously, there's a lot of fads and there's a lot of events going on, especially in the last 12 months. We had the inauguration of Trump. We had the Australian federal election. Obviously, interest rate decisions all through the year. Iran versus Israel. There's been a lot going on. You know, when we talk about, macro events, it certainly has been a busy year for us, but taking away all the emotion, what are we looking at right now? Global GDP growth is going to moderate down to 2.4 to 2.8% for 2025, which is orderly. That's the funny thing. Central banks, they talk about their band, it's 2 to 3%. So we're looking at, depending on the country, but when we look at an average across the world, we are looking at, sort of at the upper end of that band. More advanced economies like United States, UK, they are a bit sluggish at the moment. Emerging markets are actually resilient, but that's uneven across geographies. Inflation-wise, disinflation trend continuing globally. Things are starting to come down, except Australia. That's been a bit of a surprise over the last month. With CPI easing back to the 3 to 3.5%. So still above that sort of target band that the central banks around the world like to target. Global rate cuts slowing or paused. Central banks are diverging. You got the US Fed, they're being more cautious. European Central Bank and Asia are easing faster. And we'll go through in the later slides to explain why that is. And from a market point of view, what we're seeing is a shift from a rates-driven market to a earnings-driven market. So the market's always loved a good rate cut, especially when it's aggressive and coming down fast. It's fueling the economy. And the market will always back that from an investor point of view. Now that we're coming to the end, if not the end, in some countries, we're now looking at the actual fundamentals behind companies, behind sectors, behind countries, as opposed to just purely the interest rate narrative. On the Australian side, GDP growth is a bit more sluggish than the rest of the world. We're between 1.8 and 2%. Consumption has rebounded, and that's what we saw in the latest inflation numbers, but productivity remains weak. You'll see the P word gets mentioned a hell of a lot by the Australian government, and it is a big cause for concern in Australia. Productivity has actually gone backwards in the last 15 years. So that is a big problem. Even though we have more bums on seats doing jobs, the output and the throughput is getting less and less and less. So that's a big problem that the Australian government's trying to handle right now. Inflation-wise, around the 3% mark, trim means 2.7 to 3%. It's pretty much keeping the RBA cautious. When RBA or any central bank passes through rate cuts, what we do tend to see is a filter effect that can take 12 to 18 months from that first rate cut coming through to start to flow through to the economy. And that's what we saw over the last couple of months. So right now, the RBA decided on the Melbourne Cup Day to leave the cash rate unchanged at 3.6. And there is a chance that that's may not change for the foreseeable future, and the next move may be up. So we'll run through that in today's presentation. Housing prices remain up about 5% year to date. Affordability challenges remain the biggest problem, despite the rate cuts, and we'll talk through that as well. So without further ado, I'm going to hand it over to my colleague, Adam Prentice, who's going to run us through the Australian equities and international equities update.
Awesome. Thanks, Brett. Dealing with Australia first, this is the ASX 200 graph year to date, so 2025 calendar year. Showed early signs of, positivity despite domestic slowdowns. Over the whole time period, the ASX was up 3.6%. So market was supported by stable rates, strong dividend yields, with the volatility side coming from global trade uncertainty, which is shown around that February-April period, and the fall there. That was when Mr. Trump announced all of those threats that were put into effect. And then commodity price swings on top of that. So as we all know, the Australian market is based on financials and commodities, so they do have a big effect on the Aussie market. So 3.6%, you may say, not a great performance, but if we take into account a couple of factors, it makes it not look so bad. So ASX 200 grew 11.49% in the 2024 calendar year. That's a great year. So off the back of that, it is pretty natural to see, maybe a slower year. If we do take out the latest dip, which has occurred in the past, let's say month, we'll be looking at a return of 10.91% to that peak up there. So the year's not over yet, and hopefully it's positive news into the Christmas run. Perfect. So just breaking down, a couple sectors and what's been happening. So the leaders have been the financials, communication services, and healthcare, off the back of strong earnings and defensive positioning of those types of stocks. Lagging sectors, so your REITs, those are your income producing real estate assets, include commercial properties. So you're talking office buildings, retail spaces, hotels, industrial parks, as well as financial assets like mortgages and securities. Consumer discretionary, so those are your more higher-end brands, softer demand due to more cautious spending. So earnings resilience has been a positive, so corporate earnings held up despite slower GDP growth and margin pressure. What I will say about when companies are, reporting during reporting seasons, they're becoming more and more volatile on the ASX side of things. Investors are not taking any negative news lightly. We've even seen some extreme reactions in reporting seasons when expectations are met or in line. So it's just an interesting space that we're in there. Perfect. So valuations. The ASX is generally seen trading around long-term averages at the moment. Forward price to earnings are around 16 to 17 times. Full valuations are supported by resilient corporate profits, especially as companies adjust to the higher costs and slower consumer demand. Dividends remain a major component of Australian markets with franking credits. They always will. Earnings trends, so the market's expecting single mid digits earnings per share growth consistent with forward earnings projections of the ASX 200. Financials and healthcare are consistently highlighted as the reliable earners and contributors to this, while small caps and selective growth sectors may see stronger rebounds if interest rates continue to ease. On the macro influence, so sticky inflation and slower GDP growth are, the main macro headwinds, as Brett touched upon. The RBA is expected to keep rates on hold unless inflation falls more rapidly. So stable rates are regarded as a positive for REITs, while risk of a surprise rate hike or slowdown would be an upside. Bit on the sector themes again, so financials benefited from stable credit conditions and margins normalizing, and those are the interest rate differentials of what is charged and offered to customers. Bank earnings are expected to stabilize if these rates, the volatility of it subsides. Resources, so commodity price swings are obviously tied to China's demand and global energy transition. Risks are the Chinese property sector, mining capacity, and the price volatility in lithium and other strategic minerals. On the tech and healthcare space, so structural growth in tech and healthcare is still intact, with digital health and software sectors seen as robust longer-term themes. And capital expenditures are still there on the tech side. So any interest rate decreases in the year that has passed and any in the future decreases their cost of debt, which reduces their expenses. Bit on the risk side, so top risks is the global uncertainty between China and the US. It's forever ongoing, particularly with Mr. Trump in charge. Weaker domestic productivity, so Australia is a lagger in that respect. Geopolitical factors, they're always there as well. Any sort of spike in inflation or hawkish RBA policy could undermine equity valuations, while sudden changes in bond yields may drive volatility too. International equities. So on this slide, we can see some returns of various stock markets. So I'll just run you through them. Top blue line is the Nikkei 225 in Japan. Next one down, the green one, is the FTSE 100 in the UK. Orange line is the German stock exchange, so the top 40 companies there. SPX is the S&P 500, that white line, and then down the bottom there is XJO, which is the Australian market in that more teal color. These graphs are all denominated in the country's local currency. So while it looks like Japan up there has shot the lights out, the yen has been really struggling. So that does eat into returns. So just take that with a grain of salt. The important part that we're trying to emphasize here is having multiple currencies and stock markets in your account from a diversification perspective will benefit you in the long run, because coincidentally, the US market is doing very, very well. And I'll go into that on the next slide. Awesome. So US performance, the S&P 500 really surged in 2025 on an AI tech rally. So semiconductors, cloud software, growth stocks beat the value stocks by a wide margin. So some of those outperformers are the names we hear a lot: NVIDIA, Microsoft, Alphabet, being quite heavy contributors to that. On the developed market side, Europe and Japan contributed modestly, despite what that graph showed. The Eurozone benefited from rate cuts, while Japan struggled with that weaker yen and physical stimulus. On the emerging market side, so it was a bit mixed. China was volatile. There was a rebound in Q3 on an AI hardware boom, but software and services lagged in that respect. South Korea and Taiwan were strong on semiconductor demand. India and Brazil also posted double-digit gains. So looking forward in 2026, US S&P 500, these are the major companies we hear about. The forecast is between a 10 to 15% upside with the target range falling into that band. Drivers, AI is still a driver with the CapEx or capital expenditure that's still going into them. Strong earnings per share growth of around 12% and easing rates, which is something Trump really supports. Risks, tech concentrations and valuation stretches. So a lot of the hype is around these AI stocks, and I will go into a bit around that bubble in a bit. The MSCI World, so these are the world markets outside the United States. Expected 5% gain supported by Europe and Japan. Valuations are attractive outside the US at the moment. There is physical stimulus in Europe and a weakening yen in Japan too. Emerging markets, so forecast on this side is around the 9% upside. That's the MSCI Emerging Markets Index. Leaders, we're looking at India, the ASEAN region, like Taiwan, South Korea, semiconductors and AI hardware are prevalent in that place. Risk, China slowdown, tariff uncertainty, and geopolitical fragmentation. Sector themes, so tech and AI are still dominant globally. Those are the ones that make the headlines. Energy transition, so we are moving to renewables and electronic vehicle supply chains remain strong. So that's obviously shown by companies like Tesla. Financials, so we will benefit from lower rates and credit stability. It does take a while for these to flow through into the economy, but we will see that come through. All right, so AI, is there a bubble? There is a growing concern about this bubble. There are similarities being made to the dot-com era with recent market commentary and reactions. So experts are pointing to AI-related tech companies holding extremely high valuations. Price to earnings multiples are forward-looking through the roof. So there are thoughts that S&P 500 is trading at historically stretched levels, which are being driven by these companies. Warnings from major analysts, so you're looking at Bank of England and IMF, warning around a risk of a sharp correction if the gap between AI hype, profitability, and real-world returns doesn't close by 2026, which is what we may be seeing right now. Recent episodes of tech sector volatility too, including high-profile drops for leading AI firms, are fueling the narrative that some AI-linked stocks may be over their skis. Capital expenditure. So there is 1.1 trillion coming in the years to come, which is a huge amount of money. Sign of transformational change, and some argue, that there are speculative bubbles. So market consensus and outlooks for 2026 see the risk of an AI bubble as real but nuanced. Large established tech leaders with clear AI monetization pathways are likely to be resilient, while overvalued or unprofitable AI startups face high risks of collapse. So overall, the sector is expected to undergo a period of disciplined evaluation with investor scrutiny focusing on genuine earnings of delivery, not just AI hype. So just putting that into perspective when comparing to the dot-com bubble. When the dot-com bubble appeared and there was cracks starting to appear, there was still a doubling in valuations in the next year to come, but before there was that burst. So it's important to stay invested, because if we are on that cycle, where are we on that cycle at the moment? We don't want to miss out, so it is important to remain disciplined in that respect.
Fantastic. Well, thank you very much, Adam. I think it was a great summary of both domestic and international markets, and just how complex it is in this current macro environment. So, folks, now I'm going to run through on the interest rate side and sort of let you know where we sit right now and where we see things heading in the short, medium, and long-term future. Essentially, this is a side-by-side comparison of the official cash rates at both the Australian central bank, which is the RBA, on the right-hand chart, and then on the left-hand chart, we have New Zealand, the UK, Canada, Sweden, and Switzerland, because obviously they're the most active ones when it comes to recent changes. So what we're seeing here is their rate rises in that tightening cycle that we went through back in 2021 to 2022 was a lot more aggressive. So they actually went a lot higher than the Australian market did. You know, we only got as high as 4.35%. As you can see there on the chart on the left, the other markets got a lot higher as well too. So they have a lot more to cut and a lot more to come down. As you can see on the right-hand side chart there, we've only made one move, and the market right now is, I guess, betting is probably the best way to describe it, what the next move is going to be. There's been a lot of talk, especially in Australian press, that more rate cuts need to come through to improve affordability. However, last month we did see that inflation spike, and the RBA, they keep saying they're data-driven and they're unemotional when it comes to their decisions. Reiterate once again, the numbers are showing a different scenario to what the general people in Australia want. And I think the problem you've got is it's that sort of chicken and the egg sort of scenario, because inflation has been relatively high, the cost of living has been high, people are calling for rate cuts to make cost of living cheaper, but because those cost of living is going up, therefore the RBA can't afford to cut rates, because that'll inflame the inflationary problem that both the Australian and foreign central banks are contending with right now. So the next decision, we've obviously got one more before Christmas, and as I'll show you shortly, it doesn't look that promising for Santa to come down the smokestacks in December to deliver Australians a nice little present. So the outlook for the 2026, the US Fed's expected to gradually lower rates a bit further. And as you can see there, by no coincidence, everyone's targeting a rate of around 3.3 to 3.5%. Surprise, surprise, very close to the Australian rate. That's that sort of happy place that central banks like to play in. Key drivers for those further cuts: cooling inflation, obviously slower employment growth. That's a big one that the central banks look at. Muted recession risk. I mean, as Adam said, you've got strong earnings by companies, so we're not seeing it slow down on the commercial side. So we're going to look at a scenario of, okay, companies are doing okay. How's the punters? How's Mr. Smith in Alabama going? And that's what Jerome Powell will be taking into account. Central bank officials, they keep emphasizing they're going to reduce rates lower than the market expects. So the market wants it all now. And at the moment, it's death by 1,000 cuts on the US side. There is a chance, certainly, that they may hold off for even longer again. Once again, Jerome Powell says the same language that Michelle from the RBA says. They're data-driven, so the numbers will tell them which way to go. Obviously, the US economy has just come out of that. US government has just come out of that the closure, I guess you could say, and there's actually going to be a lot of economic data we may never see, because the US government was shut down while that data was being prepared, and we always may have a black hole when it comes to October's numbers. We'll wait and see what the government does about that, but it does mean the US Fed is in a bit of a blind spot because they don't have access to that information. Globally speaking, central banks in Europe and Japan are moving at varying paces, but the overall bias in advanced economies is towards moderately lower rates, driven by disinflation and modest growth. As we said before, the GDP growth of a lot of these countries is slowing down. So with that slowdown comes less growth, and less growth enables the central banks to reduce interest rates down just to try to support them. Bond yields may not fall in parallel with policy rates. That's an interesting one right now because of volatility, due to persistently high debt levels and fiscal pressures in developed markets. So in the past, we used to use bond yields as a bit of a canary in the coal mine to determine what's actually going to occur with respect to policy rates. But at the moment, we are seeing that detachment from the two. In Australia, on the ASX, we actually have almost like a rates predictor. And essentially what this shows, it's on the ASX, you can look it up quite easily. It shows that the market is not actually expecting very, very little change over the next 12 months out to April 2027. Sorry, a bit further than 12 months, that's 18 months. And that is a really, I guess, what we're seeing as well too, where Adam and I and the rest of the Atlas Wealth Group team sit. There's not that catalyst to bring rates much further down, if any at all. And as I said, depending on what happens and depending on which way the economic data goes, we may be here for good, and then the next move may be up. So that's got to factor into a lot of scenarios when it comes to different asset classes, different markets, and different investment theologies. Which leads me on to the next big topic that Australian expats love to contest, Australians in general too, but certainly expats as well, and that is Australian property. So here we have obviously a great little synopsis of what has been occurring in the Australian market, especially over the last 10 months, 11 months I should say. Still cannot get my head around, it's November. So change in dwelling prices, Australia across on average, looking at 6.1, combined regional sitting at 7.5, and the capitals at 5.6. We obviously have had some standout performers with WA, South Australia, and Queensland. Then obviously, and this is on the regional side, obviously there's a lot of reasons for that. That tends to be where the action is right now from a internal migration or domestic expats, as I like to call them, as everyone moves around, but also as certain markets get more expensive, people will direct their capital to more affordable markets, and that's why I think we've seen a lot of that money flow into WA, South Australia, and Queensland. Obviously, Victoria has its problems, and combine that with its taxes, we have seen a bit of an excess of capital coming out of Victoria to fund those other markets. Capital city-wise, obviously Darwin, I never thought I would have said Darwin's the leading performer, but I think that just comes back to my earlier point, that investors will always look for a cheaper option if their preferred options are unaffordable. And I think it's safe to say with the average prices in the major other markets, Darwin is appealing not because people like Darwin, but just because you can get more bang for your buck. Obviously, second and third there, we've got Brisbane and Perth at 10.8 and 9.4. Brisbane, I think it's a combination of, internal migration going on in Australia combined with the Olympics. I will place a warning on the Olympics that every day, we get closer to it, the spending levels seem to be cut back, the plans seem to be cut back. So people who are relying upon this massive capex spend on the infrastructure, it may not eventuate to the levels that were initially announced when Brisbane first won the contest. So just watch that space carefully. Obviously, Perth riding on the back of the commodity freight train. That one is the most sensitive to that. So you can almost draw a line with, iron ore prices and Perth property prices as well. So watch that space. If you do see any bad news coming out of China, then that will obviously filter through into the Perth market as well. The chart on the right shows the cyclical nature. So the current growth phase is positive, but well below the 2021 peak. So we're not seeing those massive run-ups again. And those massive run-ups, surprise, surprise, coincided with record low interest rates. So I don't think we're going to get back to the crazy days of 2021. When we go through and break down the different rental rates, and this is interesting to see here, from a yield point of view, 9 times out of 10, Australians can't really afford to buy Australian property on yield alone because the land tax and body corporate and all those sort of fees do tend to eat in things quite aggressively, which is why we start to see investors starting to focus on regional areas from a yield point of view. Obviously, those folks who do have family back in Australia or who have moved back to Australia recently, have seen firsthand with that rental shortage how those rental demands have spiked up. So there's a bit of a cyclicality process in the rental yields right now. When they do start to release more supply, you'll see those sort of yields come back. But generally speaking, 4.6% across Australia on average is a lot healthier than it has been in the past. So what supported the 2025 growth? Well, obviously interest rates easing. That gets property investors very excited. Brisbane and Perth dominating the main capitals. Sydney and Melbourne experienced modest growth, but affordability is really killing that out right now. When we look at October 25, saw the fastest growth since mid-2023, but that was pretty much fueled by the Australian government's first home buyer changes, where you're able to use a 5% deposit on a property and not get hit with lender's mortgage insurance. I'm sure those who have been in the market in the past would have loved to have that experience previously, saving themselves tens of thousands of dollars. What we see, that's a double-edged sword because essentially it brings all the first-home buyers in a very quick time frame. So we do get that surge, but that does peter out. So overall price growth was solid. Housing turnover, however, does remain below historical averages, so they're not shooting the lights out. Buyers are cautious and they're just not sure what the next move is, and volumes are down as well too. So we're not seeing a 2021 buy at any cost. If it has a pulse, you need it. People are being more cautious with their money these days, and certainly with the average house price getting so high, you can't afford to have one of those sort of whoops moments, so to speak. So from a property outlook point of view, look, we're expecting price growth of 3 to 7% over the next 12 months into 2026. Some of the drivers, if we do see interest rate cuts, if Michelle and the RBA team decides to cut rates further, that will push things up. But as I said before, and as I showed before, the futures markets aren't looking at that at the moment as a big possibility. It might be, sort of 10 or 15, maybe 20 basis points filter through down if the RBA does cut. But, we're not certainly returning to the lows. Government support for the first home buyers grant, that will obviously contribute to higher prices, but we do see a tapering of that. Once you get that surge of first home buyers who couldn't afford to put 5% plus the lender's mortgage insurance into their properties, now they don't. You always get that run to the gate, so to speak. But that will, after about 6 months, taper off quite aggressively. Supply constraints are still there. There's a national housing shortage that remains, and although migration and construction pressures are easing, they are still definitely there. To me, it's more about the supply issues that are around. So what could change our view? Look, if inflation remains sticky, we may not see any growth in property. We may have seen possibly the last RBA cut has been delivered. As I said before, the first home buyer stimulus is fading, and that will fade out within 6 months. Can't see any change of construction costs remaining too high. So that will price people out of the market, and their sentiment is cooling on the property side. So there's not so much that FOMO of I have to get in. Investors and homeowners are being more prescriptive, I guess you could say, when it comes to what they're buying and the prices they'll pay. So I'm going to hand it over now to Adam. He's going to run us through on the foreign exchange side of things and give us the good oil and what's going on with the Australian dollar and their friends.
Thanks, Brett. Seems like everyone's just buying in Darwin, so I might have to go check that out. But all right, Australian dollar. So this is a chart that compares it against the US. So currently it's trading in around 0.65 US cents. Year to date, it's an increase of between 5 and 6%. So quite strong in that respect. And that's probably off the back of the US dollar falling, which I will go into later. AUD against the Great British Pound, we also have seen a slight rise, whilst the AUD against the Euro is quite flat. All right, so moving into the US dollar, and this DXY tracker is a tracker against the strength of the US dollar against a major basket of currencies. So you're looking at euros, pounds, etc. Value of the US dollar against these currencies has dropped about 11% in the first half of the year, which is the biggest decline in more than 50 years, ending a 15-year bull cycle. So 10% decline is quite significant, and these are really off the back of tariffs, policy uncertainty, and global capital reallocation. There has been a partial recovery in the past few months, but the trend remains bearish. This is all on top of my points earlier about US stock market outperformance, higher real yields, the fact that the US dollar is a safe haven currency and people do demand it in times of volatility, in addition to carry trade flows. So this is where people or countries borrow from countries with lower interest rates. And in saying that, a lot of these emerging markets, countries borrow in USD. Their debt is in USD. So the AUD in context, the historical band is between zero point 0.6 and zero point 0.8. So currently we're in the lower midsection. The strength is the commodity support, as we touched upon before. Weaknesses is the China slowdown, which means less exports, less demand for AUD, and that's largely around iron ore. The Australian iron ore builds high quality steel, which China normally demands a lot of. So we are still tied to the Chinese growth. Forecast. So the forecast is to gradually strengthen against the US dollar and other major currencies over 2026. That's off the back of softer US monetary policy, favorable commodity prices, and relative economic resilience. Short-term fluctuations are expected as normal due to central bank policy signals and geopolitical factors, but the overall trend favors modest AUD appreciation. So base between 0.64 and 0.69 US cents, upsides China stimulus, softer US dollar, and then the downsides inflation in geopolitics. So what does this mean for your portfolio? We want to blend Australia and global markets for market performance, but also currency performances. In Australia, we want tech, healthcare exposures and staple holdings. They're holding up very strongly right now. And then blending in the growth sector with value stocks and defensive sectors too. They do play an important part in portfolios. Dividend supportive, so providing that consistent 5.5 dividend yields as inflation, as a hedge to inflation. So again, Australian companies pay out great dividends, and that's with franking credits. Avoid over concentration in Australia based on risk premia, so we want to diversify across the world too. This slide shows the importance of diversification. So the graph on the right-hand side is up to September 2025, so a little bit out of date, but it shows year-to-date performance till then. You can see some surprises on that list. You got Vietnam, South Korea, Hong Kong, Spain, and Austria leading the stock market returns, which is, great to see. The tailwinds in respect to these types of countries, as I mentioned before, their debts are in US dollars, a lot of them. Ones in particular, a lot of those South American ones, and Asian countries too. So weakening US dollar is a strong tailwind for them because, the currency is depreciating, less to spend. More to spend in their countries though, which is a positive on that side if they exchange it over, depending on that relative exchange rate. ASX So I did touch upon it before. Materials and financials take up a large portion of our market. Just putting that into perspective, financials approximately 34% of the ASX 200, with materials around 22%. That's 56% of the top 200 companies of the ASX. So those are old world industries, and they are to blame for subdued performance. Property positioning, so avoiding high leverage. Yes, interest rates have come down, but they are stabilizing in Australia. Keep that loan to value ratio at a sensible level, 80% maximum. So I wouldn't even go anywhere close to that. Avoid lender's mortgage insurance, so LMI, and keep a healthy buffer between the market value of your property and loan value. Focus on what has worked. Capital and regional capital cities. These are your growth corridors. Places with low vacancy rates, strong infrastructure development through state government backings and good amenities. Historical growth is over a 25-year period, not the last 5 years. So have a look into that. Caution on off-plan properties, as usual. We are still seeing builders going bust, and their expenses are still really high. We haven't really seen them come down after COVID. Modest capital growth, in various areas. So be selective, prioritize yield and stability in those areas. Foreign exchange positioning for expats, so counteract short-term needs for large transfers. If you are going to be making a large transfer, for example, a house purchase or a big loan repayment, maybe have a look at forward contracts. Lock it in so you know exactly what it's going to cost. Consider unhedged long-term assets with share portfolios and retirement holdings. When the US dollar does recover, I'm not saying that soon, but you will get that upside eventually. Use volatility strategically. So see it as an opportunity, dollar cost average, and, take the short-term wins when you're rebalancing. Be mindful of anchoring, which is only comparing your currency against one currency. Have a look at multiple and how it holds up. Regularly review your financial exchange strategy too.
Fantastic. Thanks, Adam. Well, let me give you the quick rundown, guys, the key takeaways that I hope you guys got out of the presentation today. On the equity side, we expect them to remain resilient. There will be outlying events. Obviously we've got NVIDIA's results tonight, so that'll either make or break that stock based on the expectations the market has for it. But underlying, if we look at the other 493 companies that are part of the S&P 500 as opposed to the Mag 7, there is very strong earnings growth. When we go back, and as Adam said before, go back to the boring stuff of consumer staples, cornflakes, toothpaste. There's really good money in those areas, but just not the 10 billion % returns that people have been expecting and seeing coming out of AI at the moment. So just be mindful of your exposure to the AI game. It's different from the tech boom and tech bust back in 2000s. I was in the markets at the time, and there's a lot of companies with not even a balance sheet. The difference this time is these companies are making record results. They do generate profits. It's just the expectation side and in terms of what's going on there. But, certainly the CapEx spent by the governments around the world is, supporting them as well too. On the property side, we're expecting them to cool from the recent highs. Moderate growth expected. That's as long as things remain the same as they are right now. Aussie dollar, can't see it changing too much into 2025, 26. It's going to be around that sort of 64 to 68 cent range. But obviously, a lot of things can change. They say a lot can happen in a week in politics, but, you try financial markets. Interest rates, central banks are near the end of their cycles, if not already at the end. I do think, there's a good chance that the RBA, may sort of give up on any further rate cuts and just hold the current level. But certainly from a foreign market point of view, they do have a bit further to come down if they want to sort of line ball with the official cash rates of the Australian market. Diversification, you need to be across multiple regions, multiple markets, multiple sectors. Don't get that concentration risk in a sector or a country or a company or a currency. The way that diversification works, it acts as a shock absorber. So if you do have one market that's not going well, the other market that is going well will counteract that and balance it out. And then discipline. Staying invested and maintaining a balanced approach remains the best defense against volatility. In my 28 years of guiding clients through markets, I've been through everything. Asian financial crisis, Russian debt crisis, tech boom, tech bust, September 11, the GFC, COVID, even Trump's little whoopsie back in April. And the amazing thing is clients don't lose money if they're in quality and they hold. They excel in these environments if they actually take advantage of the opportunity when markets dip and place more funds in the market as well too. As long as that money is put correctly in there, don't chase your losses. I think that's one thing that a lot of folks do. They'll have a bet and so to speak, or a punt, and keep doubling down. But if you have a properly diversified global portfolio across ETFs and some individual shares, you can ride even the most extreme waves. I said I was in this game, during the GFC when ATMs almost ran out with cash. That's probably the most extreme I've ever seen it. And guess what? Clients came through. So that's, I think, the most important part. The press are there to scare the bejesus out of you. They're there to get headlines. They're there to get a reaction. Your job as an investor is to stay disciplined. Your job is to take advantage of opportunities. Just because the market falls 5% over the space of a week doesn't mean that particular company or country is doing worse. It's just that seesawing effect that we do get in markets when volatility increases. So, guys, we're going to start the Q&A section now. So start putting your questions into that Q&A section, and we'll start kicking it off here. So, rightio. First question. Adam, do you want to take care of the first one there, mate, from Jeffrey?
Yeah, no problem. So the question from Jeffrey is Australian dollar v euro in 2026, 0.56 or better. So Jeffrey, it is sitting at 0.56 at the moment. Based off what we've been saying in the presentation, I can only see the AUD rising. Looking at the ECB, so Eurozone central banks interest rates, they can't really come down much further, whereas Australian side can, which is obviously a negative in that respect. But I think the commodities will really come through. China has been quite subdued for a while now, and that does generally carry the AUD.
Mate, great answer. Couldn't agree more. And look, it's going to come down to interest rates and all those sort of catalysts. If the RBA holds and ECB drops, that interest rate differential is going to bring the euro lower against the Aussie, vice versa. The RBA drops and the ECB holds, then the converse happens. So watch that commentary coming out of the central banks, because that gives you a bit of an idea as to what may be coming down the line. Question now from Ling. What's the latest on the proposed Australian tax residency rule changes? How likely will it be implemented and when? Great question. Probably the most popular question that Adam, myself, and the rest of the team get. Would you agree, Adam? I think it's something that everyone's hinging their decisions on, but just being mindful of. And the honest answer is silence is deafening. We did see Treasury getting quite active with it up until October last year, and then it went very quiet. So whether we see a surprise announcement coming out of the May budget next year, or whether this thing sits on the shelf for the next 5 years, who knows? At the end of the day, the current rules are unworkable. They do have to find a solution. Obviously, this policy change has bipartisan support, because we saw Scotty from marketing try to push it through when he was in term back in 2021. We have seen the consultation paper that Labor asked Treasury to run back in September 2023. So, the hardest thing is it's a bit of a political hot potato when it comes to making that choice, bearing in mind it's been almost 100 years since this thing was updated. So what it means from your point of view is that there are politicians involved who are competing interests, and the importance of this will wax and wane. So at the moment, nothing. Our ears to the ground constantly when it comes to this sort of thing, and sometimes we get surprised by these things popping out of the blue. To me, I'll be keeping a weathered eye on the May budget next year. If that does, and I don't think it will come through the May budget, but if it did come through, then it would still have to go through the lower house for voting, the upper house for voting, then to get royal assent. These sort of rule changes aren't retrospective. So consider 12 months of going through the halls of Canberra to get voted on. So if it did come out in the budget next year at the earliest, 1 July 2027, but the fact that it's so quiet on this topic means it could be pushed out even further. Albo might decide these other policies are more important. He's talking about changes to negative gearing, changes to capital gains discounts, all these sort of things. He might like to put his political tokens towards those agendas and then deal with this one at a later date. But at the moment, keep on using the old antiquated 1936 tax residency rules. Okay, on to the next one. Adam, let's look here.
Thoughts on off-plan property in the UAE? A question we do get a little bit too. So, look, it is more risky. We do hear a lot of the success stories and not a lot of the negative ones. We hear, old mate down the block bought a property and has already been offered X, Y, Z for it. Latest one I heard it was in RAC, and a great success story there. But it is more risky. You are locking in the price today. If the market does fall, you still have to pay that price upon settling, whatever your payment plan is. With a lot of these properties too, we are seeing a few problems with them structurally. So the infrastructure isn't great. They've used cheap materials, so you have to be sure of it. And look, I would say it's all based on area. Where are you buying, what's the kind of occupancy rate, income yield, etc. So I would have a look at those considerations, as well as, you want to hold this property for, we say 3 to 5 years, preferably over 5 years here in the UAE. So you can ride out any market cycles if there are any. It's not like the Australian property market where it will go up over time. We do have more volatile swings here for sure.
No, mate, great answer. And I think the only thing I'll add to that is also comes down to property type, whether it's a villa, a townhouse or apartment. There's been a lot of press recently by international agencies talking about oversupply. So I do think that in the coming years, we'll see a bit of a differing market or different returns for apartments versus villas versus townhouses. So I think that's always an important consideration because, and also the developer as well too. As Adam said, different people are getting different results. So sticking with a reputable developer is utmost, but also read the T's and C's. We have heard of stories of people who haven't been able to keep up with their payment plans for off the plan. And one of the developers said that if you can't maintain your payments, we'll only give you 40% of what you paid. So just be careful of that because that's, obviously not a great way to create wealth is if you're only getting 40% back of what you put down. Righty, Adam. Next one on to Francis. How do you think Victoria's property market will go in the next 3 to 5 years?
Yeah, great question. Look, in all honesty, I am not sure. The Victorian property side of things has been battling. I believe the figure in 2024 was negative, one of the only negative figures, -2, I believe it was. So judging by Brett's graph, it has recovered, which is a rare thing to say about Australian property. I've been speaking to some people that see it as an opportunity, but look, expenses are still high. State government hasn't been too kind in that respect, and it has led to a lot of sellers, which just wanting to get out. We have seen some large land tax bills in Victoria, so it is an interesting one. But in all honesty, Francis, I'm not sure.
I think the only thing I'll add to that, Adam, is from the opposite point of view, we're not seeing clients buy in Victoria, we are seeing them sell. So that's always a very small indicator of what's going on. But our clients tend to be pretty smart people. To me, it's the same reason why Darwin is going gangbusters. If all the other markets race away and Melbourne doesn't, at some point investors will come back to Melbourne, not because it's a good investment, but because it's a cheaper option. So I think there's a lot of political hot potatoes being thrown around, in Collins Street right now, and until they sort of solve that problem of finding that consistency and policy that is both appealing from a political point of view and a commercial point of view, which I don't think they've got right now, I think there'll be a lot of consternation. From a business point of view, we are seeing very strong language from companies saying that they would never set up in Victoria or they're moving their operations from Victoria. So, yeah, the noise around it's not good at the moment. In terms of the next 3 to 5 years, if that does go away and Melbourne property is 20% cheaper than Sydney property, then it might be a compelling investment. But I guess you just got to, like any investment, properties included, you need to be holding these things for 10 years to make sure you get a chance to ride those cycles, as Adam said before. Alrighty, next question. I'll just comment from Grant. All good, thanks guys. Informative. Cheers, Grant. Good to see you, mate. Next question we got from Amundo, Adam. What is your view regarding investing in energy companies or ETFs? Only focus on sustainable producers, or is the oil and gas still a play for diversification into 2026?
Yeah, really good question. Oil and gas. So these companies have been around for a while. They're your companies with really good balance sheets. They have stable profits that are only kind of based on one or two things. So oil prices, energy prices. That leads to them being able to manage supply of how much they're going to be giving out to people, and that can control price as well. These companies do pay high dividend yields. That could be a play for diversification depending on what you are going for in that respect. But look, more generally, oil and gas, companies, they're not there to shoot the lights out from a capital appreciation or a price appreciation point of view. They're there to be able to pay out those dividends. In terms of sustainable producers, yeah, look, it's an area that has been growing and growing. So probably for the past 5 years, a lot around ESG investing, which is around environmental, social, and governance. There have been large inflows into investments like that in building a better future. So I have seen it continue as well.
The only thing I'll add to you there, Adam, is I think we are seeing a slow retreat from the whole net zero phraseology. People are realizing the ability to achieve net zero in the time agreed is becoming more and more difficult. Well, we haven't got there yet, not even close to it yet. And people are now sort of almost finding excuses. They're saying, well, it's not ESG or it's not net zero, but it's part net zero. And I think we're going to see more and more of that as the reality dawns on folks in terms of what has to be done. And the reason I say that is there's a new CEO with ANZ, Nuno. He's a Portuguese gentleman, ex-HSBC, who fronted the Senate committee in Canberra the other day. And he was held to task about how ANZ has changed its lending policy. It's now lending to gas supplies. And he's the first that I've seen who's actually gone against that. It'd be interesting to see if other banks follow suit as well too, because Australia does have a very large energy crisis at the moment, and especially Victoria. And if they don't attend to this very soon, our friends and family back home will be, sort of operating by torchlight and candlelight, the way things are going in the coming years. So it's going to be an interesting one because it's that sort of tug of war between ethics and reality between the two. Certainly all companies and gas companies have got their foot down. We saw ADNOC, the Abu Dhabi National Oil Company based in UAE here, trying to make a bid for Santos. Those guys aren't stupid. They've got deep pockets and they know what they're doing. they wouldn't have made a bid for Santos back in Australia if they thought the industry was going the way of the dodo. So, yeah, Armando, to answer your question, as a percentage, as a weighted percentage, yeah, I don't think it's a bad investment. Obviously, if it's a sustainable one, even better. But I don't think that industry is going away as quick as some people hope anyway. So, righty, Adam, what are some diversified ETFs outside of the US to look into?
Yeah, look, so I can't give specific product advice here, but I would stick to major providers that you hear about that are more low cost. So, your classic Vanguards, BlackRock, so your iShares, Fidelity, Invesco, Amundi, just to name a few providers there. They provide ETFs that are in everything. If you're looking for a specific area, sector, etc. So just have a look at those ones.
I think also too, it comes back to what you're trying to invest in. Is a thematic ETF, for example, there's cybersecurity ETFs out there and all these different ones that tracks particular sectors, or is it a country ETF? You're almost sport for choice. Just be careful. We have seen clients turn up with a virtual shoebox of ETFs that look great on paper, but when you stack them all up, there's a lot of problems how they correlate to each other. So just be careful when you do build ETF portfolios that you take into account how it all works in between. But yeah, as Adam said, we can't tell you, particular ETFs because, as I said at the beginning of the call with the disclaimer, all the information is general in nature. But there are stick to main players, your iShares, your Vanguards, your Beta shares, those sort of things, and have a look through those lists because I'm sure you'll find, there's a suite of things you can choose from. Rightio, Adam, next question for us is, what about purchasing property in Canberra compared to renting? I might go start with this one and I'll see how you follow. Canberra is an interesting one. And the reason I say that, never lived there before in my life, but friends, family, clients live there. One thing I find with Canberra, it lives and dies by public sector hiring. So when we have a particular government in play, usually Labor, they tend to go heavy on manpower for government services. We do see that balloon of population and we do see property increase. I would love, and I've never done this, but it's always been in the back of my mind, I always would love to actually find a chart that correlates Canberra's property growth with the politicians in power at the time and the population size. And I reckon there'd be quite an interesting chart. So essentially you could almost forecast, if Albanese's got 2 terms in place, then the Canberra property market's great for the next, sort of 3 to 6, 6 years. I don't know, Adam, what are your thoughts?
Yeah, look, I would take a more spreadsheet type answer. I would go, okay, what's the potential property, increase in that time be what I would pay in rent, and expenses, etc., and go about it that way. Again, don't use the past 5 years performance. Look at the longer term and maybe be conservative, give it a few percent less and see what the outcome looks like.
Great advice. Next question from
I'll
Ray.
let you, I'll let you take this one. So what are your thoughts on LICs? Because I know you have strong opinions about them.
Look, LICs, generally speaking, are the old-fashioned version of an ETF. That is passive, that is active in nature. So for folks out there not sure what an LIC is, it's a listed investment company. Argo Investments is probably the most famous one. Djerriwarrh is another one that were listed on the ASX, have been around for a long time. And essentially these are holding companies that would go and buy shares on the ASX 200, and they wouldn't buy it at all. They'd buy ones that they like at the particular point in time with a bent. Argo is famous for paying high yields and fully franked dividends. So investors and retirees would especially love those. To me, it depends on whether you want active or passive management of your portfolio. So if you want pure slave to the index, passive, whatever the index is, I'll have, then you wouldn't look at an LIC. In saying that, if you looked at an active one, then there's Sol Patterson's, not anymore though, but there's a few out there that are active. But now we also have active ETFs as well too. So I'd say it depends on how involved you want to get yourself, because you will have to monitor it if, make sure they're doing a good job with your money. So if you are involved, I think the best way to describe it, though, to me would be you need to look at anything is a good option to invest. I'll rephrase that. It's better than sitting there doing nothing. Whether you do an Argo Investments or Djurawar or a iShares ASX 200, you're all going to make money on those investments. In terms of splitting the needle and the finite returns, that's when it comes down to, the more effort being put into these things and making sure of it. LICs aren't a bad investment. It just comes back to what the LIC does in the background. Are they active? Do they have a particular bent or thematic approach to different investments? Does that align with your investment style, risk, return, and those sort of things? So I'm not against LICs, but just they're an old-fashioned version of an active ETF. But Adam, what's your thoughts?
Yeah, I would just mention costs on top of that. Like, have a look at what they're charging. Active managers normally charge a higher proportion for their services, no matter if the market's going up or down. So, yeah, I would have a look into that.
Yeah, I think another way of looking at it, it's an listed managed fund is probably another way of describing it as well too. Question here from Francis. Which state or city do you both believe will be the next Darwin? Hashtag punt. I love that. I'll go. If you want, you pause there, mate.
Yeah, yeah, look, I'm not sure. Maybe I'll go left field and go, somewhere in Tasmania or something.
Yeah, no, that's a good bet. I mean, I sort of almost showed my hand before in terms of it could be Melbourne, but unlike Darwin, Melbourne has sort of a lot of problems out from a politics point of view, and all the other headlines we're seeing regarding crime and policies and stuff like that. So there's a lot of water to be fixed under that bridge, but being a major capital, it is a safer bet. To me, I certainly don't think. I think Perth is, there on the back of the dump truck. So I'm concerned there. Adelaide seems to be sorting its problems out. It's had for many, many years. I don't know. I think it could be a changing of the guard going forward. I think at some point people got to look at Brisbane versus Sydney and go, well, Brisbane's almost at Sydney prices. Maybe Sydney's better. Yeah, it's a tough one. So sorry, Francis, I don't actually have an opinion there, which is quite rare. Okay, next question. What's your view on investing in property in the UAE for an Aussie who is a non-resident for tax purposes? Adam, I'll hand that over to you, mate.
Yeah, so as I touched upon before, the UAE property market is not like Australia's in terms of a consistent, price increase. It does swing more rapidly. It's not a mature market. So investing in property, we want you to hold it for a long time period. Australian property is designed to increase in capital value. That's what it's there for. The yields on it aren't so high, whereas the UAE, price increases that they sometimes come depending on what market cycle you bought in, but the yield on it, the rent is high. I'm sure we're all, of those who live in the UAE, we do pay high amounts in rent. So it depends on what it's for. If it's for you to live in and save rent, sure, go for it. If it's for an investment property, then we start talking about loans. Okay, loans are quite expensive here. For the first 2 years, you don't actually pay off much of the principal of the loan. You're mostly paying interest. And then there's all these fees as well in buying properties here. We do see fees of between 7 and 10% of loan values. So I would just be cautious of that too. But yeah, Brett, anything to add to that?
Just the cycles in the UAE are bigger, when at the peaks and the troughs. So if you really want to play a conservative card, you want to be holding this thing for 10 years. You'll go through 2 or 3 cycles in that time frame, but the chance of coming out with greater than what you put in initially is probably greater. Certainly wouldn't be buying. If you're moving to UAE for 2 to 3 years and leaving, I would never consider it. 5 years is probably the earliest you'd consider it. 1 or 2 cycles there. as Adam said, the costs of getting in are quite high. And Mr. Murphy, from loves to raise his head every now and then in terms of Murphy's law. And the last thing you want to do is get into a property, ride a cycle, and then when it comes time to get out, you're behind on your costs of buying the property, and obviously the market's down. So you need to be in there for long enough to have made a chunk into the mortgage, also to be able to ride the cycles as well too. The next 3 to 4 years could be a pivotal time for property in Dubai, because there is a lot of talk about 2027 and a supply glut hitting. So, it may actually favour investors. You could walk in and buy something at 80 cents in the dollar. I don't know. I think that's the problem about Dubai and the UAE property market is, it's still in its infancy, it's still developing. And, so we can't really look to more mature markets to dictate what is next, because no one's really been through this in the current sort of shape or form. Right, our next question, mate, is from Brianna. Are there any new nasty tax changes targeting expats in the near future expected? I'll only say one thing: politicians. Who knows? But Adam, I'll throw it over to you, mate.
Yeah, so you briefly touched upon this before, the impacts of maybe getting rid of franking credits or negative gearing. So franking credits are given to investors because companies pay profits on tax every year. So it's not fair for us as individual investors to be taxed on already taxed profits. If franking credits disappear for expats, that means withholding taxes paid on dividends will increase. There will be no offset to it. On the other side, negative gearing, if they get rid of that one, there's going to be a lot of furious people, just like franking credits. But that will mean, for things like an Australian property, if you're earning income minus expenses every year and those expenses are lower, could generate a tax bill on your tax return on the outside, which will mean higher tax payable in Australia or less tax loss. So those are the two ones that have been talked about for years and years, and they will impact expats as well as current residents.
Yep, Matt, well said. I think to me there was that productivity council commission, some buzzword that Albanese used back in August, where you got a few smart people together to discuss these sort of matters and others. I think the first we'll see of it will be May next year in the budget. So there'll be leaks in the build up to that, and they'll be testing the market for see what people's reactions are. But to me, nothing's been announced coming down the line. Nothing's in legislation. We all know what expats are like. They like to talk about things as if it's happened. The amount of times I've answered questions about the 45-day rule that came in 2 years ago. It's crazy. So, nothing's been announced yet, Brianna, in terms of coming down the line. Something's maybe announced that aren't directed at expats that may affect expats. So as Adam talked about, change of negative gearing. That'll obviously affect people's property portfolios, whether you're an expat or not. So, certainly I'll just put up on the screen there our social media pages. Anytime we see something, that affects expats, whether it's ongoing or new, we get it out there very quickly. So make sure you like and subscribe and, follow our pages to stay in touch there. Next question, Adam, from Emma, is any key advice on how to buy investment property in Oz now whilst abroad and do it correctly without getting the ATO offside?
Yeah, so look, there's no problem with Australian citizens buying Australian property, even if they live overseas. What I would emphasize is make sure that every single party you deal with knows you're overseas and an expat. So that means the banks know, so you're offered the right loan. Because what we don't want is the situation of you putting something on a document saying I live in Australia, and that is taken to court, and then they're like, why did you put that? You're a resident of Australia. We wouldn't want any of those things to be affected. So people still buy property in Australia from overseas. It is possible, and if you'd like to speak to a mortgage broker about it, we can put you in touch with the mortgage team who specialize in getting loans for expats.
Yep. Couldn't have said it better myself, mate. Well, good answer. Next question is comparing Dubai and Abu Dhabi, which is better and safer property investment? I'll give you my 2 cents. I think it's two very different markets. You got one that's a sort of hot and spicy, which is obviously Dubai, and then the other side you've got a more I wouldn't say sedentary market, but a more well-considered market in terms of growth. But that works in both ways too. You know, are you going to see the same growth rates in Abu Dhabi as you have seen in Dubai? I think you buy based on your requirement and based on what you need. Don't be swayed either way because, you know, when you do look at different markets, you know, I was looking at an announcement the other day. Aldar, one of the big developers here in Abu Dhabi, announced the market, and 80% of that development was sold off to foreign investors. If those foreign investors get sick of the Abu Dhabi market, you know, that's 80% of sellers sort of coming out of that. So I think you need to look at a lot more things than just Abu Dhabi versus Dubai. I think you look at the investment, who's buying, as Adam said, the infrastructure, where it is. You know, you can have 10 different answers for 10 different scenarios. Adam, what are your thoughts?
Yeah, yeah, very interesting one. And it's whether you believe that, Abu Dhabi is trying to compete with Dubai too. I guess from what we've seen from our side is there are a lot of Aussies going down there to live and work. If it kicks off, maybe, but again, depending on areas, like where are you buying, what type of apartment, or is it a villa, etc. It is quite important in that respect.
Good answer, mate. Good answer. Just a quick question here from Armando. He's just asking, yes, so we will be sharing a copy of this presentation in the notes. We'll also be sending out a recording of this session as well too. So that'll come out to you guys in the next 24 hours. Another question here from Ray. Can you buy a property in the UAE inside of your Australian SMSF? I'll give you two answers to this, and it depends on where you're located. If you live in Australia, then the answer is yes. Obviously, the reason I say that is you can only live in Australia and have an SMSF with central management and control being in Australia. If you're an expat living overseas and have an SMSF, you do need to get someone who has a lot of experience in advising expats to look over that SMSF, because generally speaking, SMSFs are not available and not allowed for expats because central management and control has to be in Australia. And obviously, if you're an expat living overseas, you're overseas. A lot of accountants will push the whole point of just swapping over the directors of the trustee company or trustees themselves, pretty much rubber stamping. So when it comes to avoiding that, because the ATO does not like, and it is really passionate about this now, when the trustees different from the beneficiaries, because if the trustees are different from the beneficiaries, then technically it's not a self-managed super fund, is it? So it doesn't fit the brief. The other thing I will say too is the ATO are now actively calling trustees of SMSFs and questioning them, making sure they know what's going on, because if they get a whiff of you being overseas pulling the strings, then your fund will be deemed non-compliant and you'll lose 46% of the balance. So just be very careful. So Ray, to answer your question, yes, you can buy a property through an Australian SMSF as long as you're an Australian tax resident.
Yeah, and your SMSF trust deed and investment strategy allows for it too. Those are key points as well.
Good point, mate. Good point. Question from Fiona. Thanks for the great presentation and appreciation for the Q&A. Great. Thanks, Fiona. Good day in KSA. Last question, mate. I think we'll wrap it up here. We're sort of running out of time. So question from Anonymous. Are villas in the UAE less likely to have construction quality issues than apartments in large building complexes from your experience? Well, Adam, you're an engineer, aren't you? You know these things?
Yeah, I do that in my spare time for certain companies. Look, it really depends. I haven't seen, anything that says any different. Obviously, with buildings, they are kind of all linked to one, pipe or, sewage system, whereas, villas are more spread out. Brett, you live in a villa. I think you might be able to weigh in there.
Man, I think it comes down to developer. Not so much the building type, but the actual developer itself. There's developers out there where when people do their snagging lists, it's very small. And there's other people out there who, when they buy a property off another developer, their snagging list is massive. So I think it comes down to more so the developer than the actual property type. But I could be wrong. But I've got a lot of clients who know more about this stuff than I do. So no doubt after this meeting, I'll get 1,000 messages from them correcting me or agreeing with me. But yeah, to me, there's a wide chasm of quality when it comes to developers in the UAE. And I will say, just be careful of pick your developer more so than picking the style, I guess you could say. Make sure all the developers are good developer, because we have heard horror stories and those will continue as well too. Righto, guys. Well, I think we wrap it up there. Adam, mate, appreciate your time and input. And to the folks out there, this will pretty much be our last session or webinar online session for the year. So if you follow us online, you'll see our Christmas messages. But if you don't, thank you very much, guys, for your attendance through the year. And I hope, Santa Claus is good to you and your family. And I hope you have a great time and a bit of well-deserved rest over the Christmas break. We're here for you guys. There's a lot on for 2026. We haven't really touched on that yet, but keep an eye on the socials. And if you do need any help, Joe, our Marcom's lady's going to kill me because I haven't showed this last page. Hit us up at atlaswealth.com. All of our information's there, guys. We are not precious when it comes to all of this stuff. If you do have a question, I'm sure you'll find the answer there. And if not, hit the contact page and we'd love to be of assistance. So good morning, good afternoon, and good evening to wherever you may be. And Merry Christmas in advance. And we'll see you guys in 2026.
Yeah, thanks everyone.
Thank you, guys.